The dollar is powering near a two-month high, defying the shutdown chaos in Washington. And traders from Seoul to Frankfurt say the greenback's rally is just getting started. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. A surging dollar could squeeze central banks, spike commodity prices, and shake up emerging market trades. We assess the market impact with DWS APAC CIO Ivy Young, who also shares her top investment strategies. Thai stocks have been among Asia's worst performers this year. Stock Exchange of Thailand President Asadej Kongsiri will be joining us for an exclusive interview. And India's financial capital is getting a multi-billion-dollar makeover with new train lines and another airport. We'll discuss whether this will be enough to keep this bustling city moving. Let's get to our top story. Betting against the dollar has been one of the most dominant trades so far this year. But with the greenback holding at a two-month high, even in the face of an extended U.S. government shutdown, the stronger dollar trend could have major implications across global economies and assets. One of our earlier BTV guests, J Stern CIO Chris Rosbach, also weighed in on the dollar's resilience. Take a listen.
I think that the rumors of the death of the dollar are greatly exaggerated because the question is, what's the alternative? We need to get through this moment of great political uncertainty, but I think the dollar will continue as the reserve currency. And so I think the weakness that we're seeing across the board is a reflection of that.
Let's get insights, perspective from Ivy Young, APAC Chief Investment Officer at DWS. Ivy, good to have you with us and welcome to my city.
Always like to be back.
When we talk about the resurgence in the dollar, is there really a fundamental reason for that?
I would say it's more about the flow, and FX is a relative variations, right? So in the beginning of the year, I think most of people will say that a Europe or non-US dollar trade. But what you have seen in the last few months is okay, US growth seems to be not as bad as people expected. Inflation is that it will be peaking in the next few months. Next year will kind of stabilize. Particularly the key part is still the AI trade. It's still about the growth that US is bringing into the market. So all of a sudden people think, oh, US may not be that bad. And I say it's more relative, right? Right now we still believe in the medium term it's more weakening US dollar from the fundamental you're looking at it. But in the short term, given what we have seen in Euro regarding the France situations, and also people just have a concern about can European market continue to outperform? Can Euro really perform better than US? So if you ask me, is it a fundamental or is it a trade? I would say it's more the later part. It's more the flow kind of supporting the strong US dollar. And we can understand why the position like that, just given a lot of people kind of also short US dollar.
Still so much uncertainty out there, right? And so many factors in play. I'm just wondering whether the dollar is actually the least bad asset, and so they're gravitating towards the dollar right now.
Well, you can say that it's probably in terms of the beginning of the year, the position, people just put in a lot of bearish view in it. So you're right, it's maybe it's not as bad as people expected. So people going back to the US dollar and the AI trade kind of supporting it too. But on the other hand, not only just US dollar, right? Gold is another thing that we are seeing a strong rally over the last I think few weeks or even few months, you can see that. And not only gold, silver is actually better performer than gold, or platinum even better than gold. So you can see market have been looking for a lot of alternatives because overall in the market, what is not expensive now?
So before we talk about the precious metals, gold, silver, and so on, I'm just wondering, still within the currency space, it does seem like the other safe havens, the likes of the Swissy, that's become too expensive.
Yes, this is there's a concern, the valuation become a little bit higher, and then before that, people kind of putting in the yen with expectation of the interest rate hike, but now with the election we saw over the weekend, we said, okay, maybe the yen appreciation wouldn't be as fast as people expected. So there is a lot of different news flow in the market at this moment. So they're kind of supporting the US dollar in the short term.
And the yen? We have from Takaichi saying, she's watching it closely.
Yes.
She's expressing concerns about the weakness in the currency. Do you see support, and how do you see the yen trading from here?
We actually think yen should be trending higher, but the point is we also agree that what is the rush for aggressive rate hike, right? So in the next 12 months, we kind of in line with the market, pretty much expect only 2 rate hike. The policy will still be more accommodative, heading to more the neutral rates. But overall, if you ask me, is yen more have a appreciation trend, or depreciation in the kind of more medium term than just next few months? I would say more the appreciation.
You talk about expectations of 2 rate hikes
in the next 12 months.
Okay, so 1 rate hike by the end of the year. That's December, they say.
Yes, that's what people are expected for that, because if you look at the inflation funds, is it's moderating a little bit. Rice price finally go down, but it's not really going down a lot. Where we're still kind of way above the kind of 2% level that we are seeing. So I wouldn't be surprised as we see 1 by the end of the year, but in the next 12 months, we probably will put in only 2 times of kind of rate hike.
Okay, let's talk about gold easing somewhat, but still above 4,000, which is a key level.
Yes.
Is that sustainable going forward? I mean, and what's driving it? Is it central banks which keep on accumulating the yellow metal?
We say that the gold trade is actually quite clouded. Of course, central bank buying gold ETF and all those are supporting elements. But if you look at how about the retail use of gold, the demand has been kind of softening because they're more price sensitive.
So that's China and India mainly.
Yes, mainly China and India. And then when you look at it, it's more about the group of people who is not price sensitive. It's more about the trend follower. They kind of pocket the money in the gold. Market can always go in an extreme. So if you ask me, I would say the risk is quite high for it to consolidate first before the next one, because you see a lot of factor has been pricing in. The first one, if you look at the market itself, market kind of putting in a 4 rates cut by the end of next year, so the rates cut pretty much putting in. And as we touched on a lot of political issues, U.S. government shutting down, Japan, France government changes. So all these things push people to kind of park the money in a safe haven, and then there is also some people not really care about the price. So it's kind of supporting the gold rally. But how about if all these risks kind of subside a bit? The market will probably take a pause and think about, okay, it's time to consolidate before kind of another long one in the future. So in the short term, we do see the risk of consolidation. In the long term, probably we can see higher than what we are seeing right now. And what we're saying about is not just gold, right? It's other precious metals, which also have been doing pretty well. I think silver is another example, but that is particular reason with this 232 tariff concern on it. But what happened on copper when the concern subsists? So that's the sort of thing that I think market has been trading on a lot of news. There is some fundamental reason between silver catching up about the gold price, narrowing down the spread, but there is a lot also about the concerns that people have on the tariff, and particularly you see that a lot of silver has moved from London exchange to the US because of the tariff concern, and London is wanting a shortage of silver. So all these things adding up kind of fueled all this commodity boom that we are seeing in the market.
You're saying consolidation is coming. It is a very crowded trade, and we know,
yes.
yes,
everyone knows.
When there's a herd mentality, they say sell. It's not time to buy. But if you're expecting consolidation, how deep might that be? Because the likes of Goldman say that gold is getting to, I think, 4.6 or 4.9. So the trajectory is upwards. When do you buy when you see consolidation?
Well, I would say it's easy to see 5-10% downside, but can it go down more than 20-30? I also don't see the reason, even though I say it's a clouded trade, because in the fundamental, the world is indeed full of uncertainties that we mentioned about, and it's also what are your alternatives, because equity market, bond market also getting expensive, particularly for the major market itself. So I would probably say that single digit kind of corrections is easy to see, but large scale corrections, I just don't see that it's happening.
And another crowded market, of course, the AI trade, and now suddenly,
yes,
right, people are getting nervous. Circularity of investments. How are you looking at it?
I think the AI trade at the end is like about the growth. Like probably I'll be in better position to talk about it when the result season kickstart in US like next week. Then we will definitely watch out like how is the growth, how is like the guidance from the management, and particularly on all these CapEx is still continue to be going on with the AI deployments and all, right? But I would say yes, you can say that is a clouded trade, but look at the last few years. If you look at like the tech stock of Magnificent Seven in terms of their earning growth versus like the other stock, they did deliver very decent earning growth, right? From like what we see like 30% to like mid-teens and all versus the other stock.
You never see the bubble coming. The question is, how do you play this AI trade right now? Some suggesting perhaps the way to do it is to actually invest in the AI infrastructure, those powering your data centers, for instance.
Yes, infrastructure definitely is one of the trade that like people focusing on it, and like it also makes sense because you think about like in order to have like all these like AI deployment, like data center is a key part, and like for data center, power is the thing, right? So it's not just about like energy pricing, but how about the power transmissions, like smart grid, like all these things. All the thing is a kind of supporting about like the AI sector. So I would say like it's not just about the tech stock, it's not just about Magnificent Seven. The whole trade you can actually expand to a lot of midstream energy company in infrastructure. They're also getting benefit, and of course in the real estate space, data center is also something it will get benefit. But the whole thing again back to the starting point, right? This company has to deliver the earnings, and that the earning is still relatively okay, I would say. But market watching very closely every quarter after quarter. What is your guidance? Can you really monetize it? And this is a big question mark in the market right now.
Well, the big question mark is not just the earnings, but also data out of the U.S. economy. Given the shutdown, you're not even getting that data. So how much clarity are you getting, and how is it influencing, shaping the way you look at your investments?
I would say that like yes, U.S. data like that's a question, but like we also have pretty like comprehensive analysis about like how we look at like U.S. market. Maybe you don't get the government data, but U.S. actually you have a lot of data where you look at the consumer side, like how is the retailer doing, how is the shopping mall doing, like how is the Visa, MasterCard data. So we do have all sort of data to kind of analyze what is the U.S. economic situations that what we are seeing. So far we will say that when you look at our house view, we're thinking about like this year probably like 1.5% GDP growth we're seeing in U.S. next year 1.3%. It's still a growth market, but it's just moderating down. So that's why it's more like look like a late stage kind of expansion, like when the growth kind of moderating that we are expected to see. But like when you compare with the rest of the world, everyone is kind of heading similar direction. So back to the starting point, where is the relative value, and like which one is like relatively holding well?
Where is the relative value, and where else can you find that value in the next 12 months? And what are some of the changes you've made?
So I would say like overall, like when you look at across all the major market right now, from a valuation perspective, if you just compare with the historical average, most of them are quite expensive. So then the point is not about like just compare with historical advantage. So then you have to think about, okay, which market can actually have multiple expansions? And then, or which market can narrowing down the gap that we are seeing between their market versus the US market. So European market is what we like part of the reason is just because about the valuation gap we are seeing between the US and Europe. Particularly if you think Europe, Germany is where we are positive.
I am going to take issue with that. You've been very positive European market since I think the last time we spoke in August, right? But take a look at what's happening in the political scene. I mean, France putting a lot of big question marks when it comes to the outlook for the economy in the Eurozone as a whole. That is a huge risk. Why are you still thinking that Europe is the place to be?
I would say like we are like right now our stand on Europe is still more neutral like overall, but within Europe we think Germany is the place to be. There are two parts. Okay, for equity market perspective, actually if you look at European company, a lot of their earnings is actually from overseas, okay? So it's not just like with the domestic European countries, so there's one part. And second, yes, while France faced the issues, like we can talk about it whole day, but Germany does have a lot of bright spot that we are talking about. We definitely touch on the fiscal stimulus we're talking about. Yes, we're very positive, but we never be a camp that we say, oh, that like this is $1 trillion flowing into the market, like in a short period of time. We never say that. But if you do the math itself, there's really incremental of the money they're going to spend on the infrastructure and also defense and all. The fiscal multiple from it in the beginning may not be that high. But if you look at quarter over quarter, like next year, that we definitely see that it's picking up. So we need to give a little bit of time. And then like within Europe itself, like Germany is very positive. And then we go to the Asia market, like China has been doing very well. Like, and then recently with Vietnam, like promoting to like EM market, but they have already doing pretty well even before the promotion. Those are the market, you see some structural change, right? Those are the market more about, oh, is there potential for the multiple expansions? Like, of course, the earnings have to catch up, but like the multiple is really the key questions that we look at.
The top asset for you in the next 12 months and the top market for you in the next 12 months?
We're actually quite positive. Like, I would say overall the market, we put at neutral, but then like in Europe itself, I would say like Germany is what we
top
like.
Market,
in Asia,
class?
Okay. Asset class, each of the countries are quite different, but globally in terms of asset class preference, we actually think like the healthcare will be potentially doing better, just given the valuation is trading. Of course, we think the AI trade will also continue with the earning that they managed to deliver. And in the Asia funds, like each of the countries are quite different. China, we still like the AI and tech theme in China. I think we touched on it before. That's still what we like, but we like the barbell approach as we discussed, right? We need something with high dividend stable first. On the other hand, like we also want something to be growth. But we also see that in some of the emerging market, there is also some potential that we are seeing, or like developed market in Asia. I still like the Singapore market. I remember I talked about it. It's relatively small, but then they have a lot of potential.
A very diversified portfolio.
Yes.
Ivy, thank you so much for that. Ivy Ang, Chief Investment Officer, APAC at DWS. Great perspective there. Still ahead on Inside, New Zealand's Finance Minister explains why she expects a return to growth next quarter. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. New Zealand's finance minister says she expects the country to return to growth in the third quarter with further acceleration in 2026. We spoke exclusively to Nicola Willis and asked her why the economy has been so fragile with a bigger than expected contraction in the second quarter.
Look, we know with the seasonal variation since COVID that those numbers have been jumping up around, and there could be some correction to that figure at a later update, particularly given some of the technical factors in that measure. But we were expecting a negative second quarter, and what we saw is after 6 months of strong growth and recovery prior to that, including a 0.9% positive rate in the first quarter of the year, that on the 1st of April, when the Trump tariff announcement occurred, that really knocked confidence out of a lot of New Zealand businesses and investors who looked at that global uncertainty, and for a global trading nation, really worried about where that would go. We're now in a much more settled environment. We know what New Zealand's tariffs are, and we've watched our exporters adjust very quickly to that new reality, and many of the worst side scenarios that had been predicted haven't occurred, and so we're confidently predicting that growth will have returned in the third quarter and should accelerate in the fourth quarter, particularly helped along with an official cash rate that continues to fall.
Yeah, I do want to, you mentioned business confidence there, and the latest business confidence report showed firms planning to reduce investment. How much of a concern is that for you?
Well, we've worked as a government in this year's budget to provide more impetus for business investment through the Investment Boost tax policy, which offers a 20% write-down on asset investments against tax bills. And that's directly intended to be a tax incentive to encourage investment, and firms have certainly said that that is something that will make some business cases stack up that wouldn't otherwise. And as we look ahead with a lower official cash rate, with inflation now now having stabilised back in band, and a government that is ultimately pro-business, reforming, deregulating, we believe that's creating the conditions in which businesses will feel more confidence over the coming months.
All right, so you're expressing some optimism, but of course we had the RBNZ, the Reserve Bank, cutting rates by 50 basis points last week, saying it's open also to further reductions. Does that suggest to you the central bank doesn't share your optimism, that it's worried the economy won't recover?
Well, I think that was the Reserve Bank doing its job of reacting to data in the second quarter that, as you pointed out, was much more negative than had been forecast and quite different from what they had forecast and what had informed their earlier monetary policy path. So the bank is reacting accordingly, and of course with that lower official cash rate, that in itself will be an inject for the economy, and that's, in my mind, monetary policy doing its job. As a government, we're working alongside the Reserve Bank by ensuring that our fiscal settings give them that room to move on interest rates, by ensuring that we're not overstimulating the economy and that we have a path of fiscal consolidation. And so, look, the Reserve Bank itself is continuing to forecast that there was growth in that third quarter, and they agree with our Treasury assessment that growth will forecast over the coming months, getting back up to very healthy levels next year.
Well, Treasury will deliver you another forecast in December in its half-year update. So what are you expecting in terms of that forecast? Do you think it could be cut? And what would that mean for tax revenue?
Well, look, so far, actually, our tax revenue is holding up. We released our 1 year in review financial statements yesterday, and they demonstrated that the tax take was actually up on what Treasury had forecast at the budget that it would be. In fact, all of the indicators in that update essentially were a little better than we were predicting. Our core fiscal measures that the government is targeting around net debt actually stayed steady. When we look at the deficit, that was smaller than we were expecting, and spending as a proportion of GDP was also smaller. We're on target to reduce that over time. So at this juncture, Treasury's updates in terms of the real data rather than the forecast data are, as I say, running positively relative to forecast.
Obviously, the longer-term goal here is to get the budget back into surplus. Can that be achieved by 2028? And if not, when do you think it could be achieved?
Well, that remains our fiscal goal, and we do think that will be achieved. In our latest budget, we were getting to surplus out a year beyond when we would like to. We've kept that goal of doing it a year earlier, and in order to achieve that, we're following a path of fiscal consolidation. We've had very low operating allowances. That's the discretionary spending that the Crown does, very low relative to where they have been historically, and we've supported that with a savings program that so far has delivered around $43 billion worth of savings. We want to get spending back down to 30% of GDP, where it's broadly sat historically for New Zealand. It leapt up over 34% during the COVID era, and we think it's a much more sustainable position to get that back down. We've charted a path that gets us there, and we're confident that that surplus path is achievable with fiscal discipline.
And that was New Zealand Finance Minister Nicola Willis speaking exclusively to Bloomberg. Coming up, the Thai Stock Exchange President will be joining us to discuss the market outlook, IPO pipeline, and efforts to restore investor confidence. That exclusive conversation coming right up. This is Bloomberg. Welcome back. You're watching Inside. Central banks in the Asia-Pac region have gone 3 for 3 this week on surprise rate decisions. The RBNZ kicked things off by cutting its key rate 50 basis points. The Philippine Central Bank also unexpectedly cut, citing economic unease amid an ongoing corruption scandal. On the other hand, the Bank of Thailand held steady even as most economists expected easing due to poor economic growth prospects, a strong currency, and a dovish new governor. For more on these surprise rate decisions, let's bring in Bloomberg's Asia-Pacific economy reporter Swati Pandey. And Swati, it does seem like it's getting really complicated for central banks.
That is right. The domestic economies which were proving to be resilient at the start of the year or even last year. Inflation was subdued in the region, and it did look like Asian central banks would actually hold off cutting interest rates. And now the dynamic is looking complicated. There is the global trade uncertainty as well. And then there are these individual circumstances that these economies are facing, from corruption, protests as well, and decline in tourism and business confidence. And individually, the economies are either needing more support, or central banks are thinking that, well, we need to hold off now and keep our powder dry for when we actually need it.
And that's precisely what happened with the Bank of Thailand, keeping powder dry. I mean, rates are already low at 1.5%. Isn't that true?
That's absolutely right. One of the reasons that Thai central bank surprised was because they wanted to show some patience. They wanted to see whether their previous stimulus is feeding through to the economy. And one of the things that they also said was that, even though the economy is weak, recent data has not been as weak as anticipated, and that gave them some room to be patient. And on the flip side, the RBNZ did not want to be patient. It had been seeing very poor, disappointing economic growth. Business confidence has been weak, and it just wanted to give that larger stimulus to the economy with 50 basis point cut. Yes.
And in the meantime, everybody's watching the Fed. Swati, thank you so much for that. Bloomberg's Asia-Pacific economy reporter, Swati Pandey there. Well, Thailand, speaking of Thailand, it plans to simplify stock listing procedures as part of a broader drive to strengthen capital market competitiveness and attract global investors. The country's stock exchange will streamline IPO and foreign listing requirements under what it calls the Thai Capital Market Attractiveness Initiative. The board calls it an urgent step as the benchmark index lags among the worst performers in Asia this year. Joining us exclusively is the Stock Exchange of Thailand President Asadej Kongsiri. Kun Asadej, good to have you with us. The big question is whether those measures will work. What's the sense you're getting?
Well, it's something we have to do. Look, I think Thailand, as you said, the economy's been a bit sluggish in the past. But from a stock exchange perspective, and together we've been working closely with the Thai SEC on this, we do recognize that a radical change in how we work to encourage and to basically do our role for the economy, being the place of raising capital to help grow and accelerate the economy is our core business and our core function.
Well, the thing is, if you listen to investors, they say that the reason why the Thai market is lagging behind its Asian peers is because of valuation, because of liquidity. To what extent are you addressing these issues?
So I think valuation comes back to fundamentals. One of the things that we've been encouraging the Thai companies listed here is to really focus on growing their earnings. Ultimately, it comes down to bottom line. So one of the programs that we launched earlier in this year, or mid-year, called Jump Plus, we named it Jump Plus, but it's effectively similar to the Value Up programs in Korea and Japan, where we're hoping that companies will come out with plans over the next 2 to 3 years of what investments they're going to make and what changes or what positive impact those will have to their bottom line. And these will be communicated to the international communities, to the local investors, hopefully by the first quarter of next year. We currently have about 67 companies signed up for this program already, more in the pipeline, of course. And then on you mentioned liquidity. It's something that we're looking at as well as how to ease regulations. We know that in the past 20 plus months, I think we've been putting in a lot of regulations that have impacted liquidity for certain reasons in the past. We will look to review that early next year. We made a promise mid this year as well that we would not look to touch or change any regulations for the remainder of the year, and we will hold to that.
might you ease regulations to attract more foreign flows? What are you looking at?
Well, so part of the trip, I'm now in Hong Kong, so this is part of the trip here is to come and listen to our international investors. We want to hear back from them, feedback, what their thoughts are about the Thai market, how about our market structures. So for example, we have this thing called the uptick rule. I think our uptick rule is slightly unique in the world where it's across the board. So maybe changes there needs to happen to ease effectiveness of market mechanisms, for example.
How challenging is it? Because it seems that it is an uphill task. If you take a look at how the market reacted to the BOT stunning pad, it was pretty muted. Is monetary policy now no longer a catalyst even for Thai investors?
Look, I think there's multiple factors involved here. Monetary policy is one that helps. I think the Bank of Thailand has been quite clear that they're being able to be, or they're willing to be patient to see how the impacts of past rate cuts will have on the Thai economy going forward. The Thai political situation obviously is relatively new. We have a new government in place that are looking to encourage investments, stimulus, and we'll see how that works out as well. So I think it needs to be looked at in multiple factors.
We've seen how hot the IPO market has been for Hong Kong, for India, and several other countries. How are you looking at it? I mean, what's being done to attract possibly dual listings, to attract all those foreign funds into Thailand?
Well, we have quite a strong IPO pipeline at the moment. At least 30-plus companies have filed for listings in the past. Obviously, the market situation has delayed many of those listings. We're looking at a pickup right now. So in the past 2 weeks, I think we've had 2 or 3 new listings on the market. And we're hoping that with this market performance or pickup in the last 2 to 3 months, people are really looking at their options on raising capital in the market. So that pipeline hopefully will materialize over the next 2 quarters. Ultimately, when you mention dual listings, it's something that we've been discussing with our partner exchanges. So yesterday I met with the Hong Kong exchange. The same topic was mentioned. It's an option that we're looking at, and we're looking to study with our exchange partners in the region. We want to together hold capital within Asia, and I think we need to help each other to do that.
So how soon might dual listing happen?
I think regulations in general in exchanges in the region are in place that allows dual listings, but obviously the devil's in the details. So all the regulatory differences in each market needs to be moved to align. So it's not the exchanges itself alone that needs to work together. We need to encourage the regulators, the SECs of each each market to work with us as well. I can't tell you of a timeline, but look, yes, please go ahead.
No, I'm happy to hear about your timeline. Do share.
Now, I wish I did have a timeline. Look, we're working on it, and then we'll update via Bloomberg as soon as we have something more concrete.
We're looking forward to that. Asadej, we heard how Vietnam's being upgraded to emerging markets from frontier status. Might Vietnam be pulling those funds away from Thailand? Do you see Vietnam now as competition?
Nah, I don't think we would call it competition. Look, Vietnam has a very vibrant economic outlook. They have a slightly different demographic than the majority of other Asian nations, for example. So I think over the course of ultimately, investors look at valuation, so it's relative. We need to do the work in our country to make our stocks, our market more attractive from a valuation perspective, from an earnings outlook perspective, from a structural regulatory perspective as well. So each market has to do its part to encourage investors and capital flow.
So when FTSE Russell says that it expects an additional $6 billion in inflows for Vietnam. That's not coming from the expense of Thailand, just to get it right.
I hope not. We'll do our best so that it doesn't happen that way, of course.
Good, Asadej. As of today, you've imposed trading curbs on Delta Thailand. Why is that? What's the thinking behind that move?
Well, ultimately, we look to warn investors. If we look at the fundamentals and the liquidity within the Delta stock itself, where price to earnings, price to book ratios, and together with what the company has announced itself, they've announced that there's no additional information within the company that they need to tell the market or the market doesn't know already. So even the company itself is signaling that at this valuation, it's tough to justify. And therefore, we're asking investors to really relook at the information flows and look at this investment or making their investment decisions carefully.
So you're saying that the price rally we're seeing in the stock is not justified, even though some may say it is an AI play. And when you take a look at how extended valuations for AI players are around the world, it's also a cause for concern.
Yeah, I think we look at it across the board. So obviously we're not looking at Delta as a single stock issue. We're looking, when we make these decisions, not only for Delta but for other stocks, we look across the board at benchmarks both in country and globally to see on a relative basis whether it makes sense as well. And I think this is not a huge impediment to investors. It's just a signal that hopefully they think twice or think carefully of the information that's available. I think the company's been very good at providing information and updates to the industry, to investors, and that needs to be taken into account as well.
As a whole, on a broader basis, when you take a look at valuations of AI plays, AI trades, are you concerned? Is there reason to be concerned? I mean, people are now beginning to talk about, that AI bubble bursting, maybe not immediately, but soon enough.
Well, I think you have to ultimately, at certain points of the valuations across the industry, you need to look at information specific to each businesses. Obviously, there's been news across the world. There's been transactions that may drive pricing in different ways away from fundamentals as well. And ultimately, at a certain level, I wouldn't be able to say whether it's a bubble will burst or not. But I would advise investors to look at specific information in each company.
And of course, when it comes to the political scene in Thailand, that's also something that investors are focused on. Elections due next year. Do you think there's any, jitters in the markets among investors that elections are coming up? Or could that be a bonus? Could that be a plus to markets?
The way we look at it, at least from the feedback that I hear from investors, I think investors generally are quite used to the activities, the political activities in Thailand. There's always changes. But in this instance, we believe that it's heading hopefully in the right direction, that eventually post-election next year we'll have a stronger, potentially a coalition government again, but again, hopefully a stronger and more stable government. Because ultimately what investors and ourselves are looking at or looking for is policies that are implemented. In the past, we hear very often that investors do like all the policies that have been publicly told or broadcasted by past governments, but they're all waiting for it to happen, to see actual investments in those policies. So we can be forever hopeful, I think.
And are you hopeful that there'll be a turnaround in growth in the economy?
Ultimately, yes, because ultimately, if those policies, because I think every government has come up with good policies, so if they can remain stable enough to implement them, I think it will be a positive for the economy overall. Because ultimately, we like certainty of investments.
Like all investors, they like certainty. Asadej, thank you so much for that. Asadej Kongsiri, president at the Stock Exchange of Thailand. Still to come, Mumbai's betting big on infrastructure to shed its underdog reputation and go shoulder to shoulder with global financial capitals. We take a closer look at this multi-billion-dollar transformation. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. India's been trading for about 3 minutes now. Here's how it's looking in the first couple of minutes of its trading day. It is in positive territory. The Sensex up about 1/10%. One stock we're watching is, of course, Tata Consultancy on the back of that miss yesterday. Currently, that stock down 0.2%. Second quarter profit missing estimates. Well, India's financial capital is in the midst of a rapid transformation, racing towards faster commutes and urban renewal under a multi-billion-dollar infrastructure blitz. Bloomberg's Monica Doshi reports from Mumbai.
There's something different about Mumbai nowadays. It looks a little bit more modern.
A sleek new underground metro line now slices through India's financial capital, turning an hours-long commute into minutes. A coastal road soon to be flanked by gardens and public spaces, and India's longest sea bridge have halved travel time across the city. And a brand new suburban airport, inaugurated this week by Prime Minister Narendra Modi, is set to open in December, ready to welcome 20 million passengers a year.
Navi Mumbai International Airport.
Navi Mumbai International Airport is a project that shows a glimpse of a developed India.
There's more. Another dozen metro lines, east-west tunnels and coastal road extensions are on the way. Together, this transformation carries a price tag of between $20 to $30 billion. It's unfolding alongside a massive push to redevelop slums and aging buildings. For Mumbai's 22 million residents, it's a promise. More homes, faster commutes, and a safer journey to work in a city where overcrowding can be deadly.
India's financial capital draws millions in the search of opportunity. Now, these new projects won't erase the slums, the traffic, the overcrowdedness overnight. But they will offer a moment of calm in a city that never stops.
And of course, Monica joins us now for more on Mumbai's infrastructure push. Monica, I mean, we can't downplay the importance of infrastructure in India's push for, economic goals. Most times, though, it is playing catch up, isn't it? I mean, India's growing at such a pace that infrastructure just lags behind.
Well, that's right, Has. It isn't just such a pace. It's also because for several years, India's large metropolises ignored the expansion, the migration that was taking place within their cities, on their peripheries, and did not do adequate planning. So I know you're very amused sitting in Singapore that here we are in 2025 in Mumbai celebrating the onset of a metro rail as if it's almost a novelty. But that's the reality right now in Mumbai. The country's commercial capital for decades has been starved of infrastructure, and now we're seeing a blitz, which I think now adds up to roughly $34 billion of spending on bridges, roads, tunnels. Of course, this is an island city, so a lot of this is now going underground to free up space on the top. And hopefully, like I've said, in that short video you saw, that will ease commutes, most importantly, make this a more productive city.
We know that it requires big funding, right? I mean, some of the numbers I see out there, $2.4 trillion needed by India by 2050. I'm just wondering how this is all squaring up, given that, there are concerns about deficits and debt. I mean, are there plans to get the private sector, for instance, involved in funding these projects?
Well, the public sector is already very involved, Has. If you take a look at the federal budget for the last 3 years post the pandemic, the government's form of a stimulus was by allocating a lot more money towards infrastructure. This year, it was about 11 trillion rupees, which in dollars doesn't seem like a very significant amount. But look, that's what our budget is, right? It's 130 or 140 billion dollars. So the central government has been spending significantly on national highways, ports, airports, airports. The state governments have also been putting money towards infrastructure, not as much as they should, as economists will tell you, because many states, to win elections, their political parties have, preferred on cash handouts. But in this metro project, for instance, Japanese investors are involved, the ADB is involved, the state government is helping fund it, the city is picking up some of the tab, and the central government is also picking up some of the tab for some of this infrastructure in Mumbai. So there is a push. Of course, money is never enough.
Like you said, money is never enough. And of course, when you talk about India, you have to make comparisons with China. And when it comes to China, I think they're spending about 14% of GDP on infrastructure. That was what happened back in 2016. And when it comes to, the plan to expand infrastructure, it's led to those ghost cities. So is there concern that this might also happen in India?
Well, there are corners of such concern. I think you would have read an excellent story one of my colleagues, Mihir, did on, airports and how I think from about 140 airports, there are close to a dozen that have been built. And, these are old airport sites that existed either for the armed forces or the government that were refurbished and built to expand connectivity in many regional centers in India. And like I said, about 12 of those 140 hardly or barely see a flight a day or a flight in even a week or a month. So there are some instances of waste, of vanity projects. And I think that brings us back to two core issues that lie at the center of Mumbai's concerns, Bangalore's concerns, where there is a war underway right now against potholes, or Gurgaon's concerns, where we saw significant flooding in the monsoon recently. And that goes down to planning and accountability. And I just want to leave you with one thought. I think about 60% of India now lives in urbanized areas. And, that's where a bunch of our growth comes from. And if we don't get all of this right in terms of infrastructure planning and accountability, it will be a headwind to India's growth.
And we know infrastructure is a game changer. Bloomberg's Manaka Doshi, thank you so much for that. Before we go, here's a look at our guest. Next week, we'll take a look at global markets with JP Morgan Asset Management. Keep it here with us. This is Bloomberg.